So today we will be discussing, last week we did the collateral, and today we are going to start discussing financial analysis, right? So we will look at what is financial analysis, what kind of things we can do, why we need, who does this important for, and how to do a analysis. It has to be practical way of looking at P&Ls and balance sheet, right? Okay. Hope everyone has the presentations. Lecture number 5. Message box is on. You can text me. Do you have the presentation with you? Okay. Thank you. Right. So today we will be discussing the financial statement analysis. What is this? Actually, by doing a financial analysis, we are assessing the past and present and predicting the future, right? No business will change overnight, right? Our past and the present will be carried forward to the future. So by analyzing the past, we will know the financial strengths and weaknesses, even the management strengths and weaknesses of a company, just by analyzing P&L, balance sheet, and the cash flows, right? So assessment of the past, present, and future financial condition is financial analysis. This is to find out the weaknesses and strengths. Then when we have opportunities, we can capitalize on that. So primary tool is the financial statement and comparison ratios. We are going to discuss in detail 10 ratios, little bit more than 10 ratios during the today and next week. I'm trying to finish it today, but if I can't finish it, it will follow to next week as well. This is the two main points, right? We have assets and liabilities. Okay, asset minus liabilities is the book value of a company. This shareholder equity should come below book value of the firm, which is called the position of a firm, financial position. We look at the financial position on a day. It is a snapshot. What is the financial position of a company today? What are their fixed assets? What are their current assets? What are their current liabilities? Right? That is the financial position. Then when it comes to the performance of a company, financial performance of a company, it is the balance sheet, P&L, right? We call P&L, but now it is the performance statement, financial performance statement. It is revenue minus the expenses, which is net income or net profit. So these are the two main statements we have. The third one is the cash flow. So these are the three statements we have. Balance sheet shows the financial position on a particular date. Then income and earnings statement represents the operations of the business. So that means how the business has been operating. That is shown by the income statement. Then statement of cash flow indicate what are the cash came into the business and what are the cash went out of the business and the reasons. Right? It is the cash inflows and outflows from the operating, financing, and investing activities. So these are the three statements we are going to work with, right? let me take you to a, yeah, let me take you through P&L and the balance sheet, right? Can you clearly see the board?
Yes.
Can you see the board properly? Why are you taking so much time to give me answer, please? Okay, thank you. So I will give you the P&L first. P&L, profit and loss statement, financial performance statement, right? We have sales, revenue, or turnover. We can use any of these words to discuss the top line of a business, right? So this is the top line of a business, which is equal to price into quantity you sell. So it can be several products. So N, it can be TVs, telephones, refrigerators, and everything. So it is the summation of this. So it is N equal 1 to capital N, right? Price into quantity is the sales. So you can have a product mix. So it is P1, Q1 plus P2, Q2, like that. You can have a large number of. So this is the revenue slide. When it comes to revenue, we have credit sales and cash sales, right? Can you see this point?
Yes.
Can someone kindly tell me fast? Can you see this point? Not clear. Right. Thank you. Revenue can be divided into credit, sales, cash, sales. Okay. Then credit can be done in bill to bill and PDCs, OGINs. These are supported documents. What is bill to bill? Bill to bill is you sell something, you will not get any cash or any supporting payment mode, which is a post-dated check or an invoice, anything we will not get. The customer will sign on your bill, right? That's all. They will not give you anything to recover the payment. So after a few days or weeks, you go back to the customer, collect the previous bill's money and give goods. So always there is a amount of money held with the customer. So that is called bill to bill. Other way is like you go sell, you get cash, that is cash sales. Then this is credit sales, you don't get anything, that is divided into bill, and you go give the goods, take a post-dated check, or you supply something, you get a GRN. right? So that is how the credit sales goes. Then when this is a percentage of credit cash sales and percentage of credit sales. Then for this you have period, right? 30 days, 30 to 45 days, 7 days, whatever. Credit period. So this is called terms of trade, TOT. Binura, can you see this line?
Yes, I can see.
Why can't I hear you? Can you see this line?
Yes, can see.
I can't hear you, Binura. Just type, please. Something wrong. Okay. Right? This is credit sales. Right? Percentage of credit sales. Then we want percentage of cash sales. Then this credit sales goes on bill to bill or PDCs or GRN. And we have a period. Right? 7 days, 14 days, 30 days, whatever the period. This part is called terms of trade, TOT. Right? This is the top line of a business. This is how the performance, how much they have sold, how much can they increase. So this is the operational level of the business. Right? Then from after the product sale, then you have direct cost. Right? Direct cost is the cost which will change with the quantity you sell. Direct cost is the cost which will change with the quantity you sell. Right? What are the costs we have? Raw material, labor, electricity, or power. This is your direct cost. Any cost which will change with the quantity you sell or produce is called direct cost. Like if I am a shirt manufacturer, my clothes cost, my material cost, my buttons cost, my labor cost, right? Labor is my factory workers' salary. Factory workers' wages we call. It depends on the number of outputs. Right? If I am a pen manufacturer, this is plastic cost. This is workers' wages, factory workers' wages. Then factory electricity, factory generators cost, the power cost. This is called direct cost or cost of goods sold. Cost of goods sold. If you see this word, it means the direct cost. Right? So then we come into first profit level which is called gross profit, right? Which is the gross profit, right? So turnover we denote as A. This one direct cost we denote as B. Then gross profit is C, right? Which is equal to A minus B, right? Gross profit, we use another term called contribution, right? That is the another term used for gross profit. That is contribution. Gross profit equals top line, revenue line minus the direct cost. Gross profit is the money available to recover your other expenses like administration expenses, profits after deducting the direct cost. Right? This is gross profit. Then after the gross profit, we come into overheads. Right? Prior to that, on the gross profit level, normally in a business, gross profit margin. No, I will tell you later. Forget about it. Overhead cost. Overhead cost we categorize into three items: administration, overhead, admin overhead, marketing overhead or sales overhead, and finance overhead. Right? Any expenditure we do to maintain the business which does not change due to the quantity you sell is an administrative overhead, like general manager's salary or factory manager's salary. It does not change with the quantity you sell or produce. Your monthly rent paid for the showroom or for the factory, monthly rent, with the revenue, whether you produce or not, sell or not, you have to incur these costs. That's why they are overheads, right? They are the fixed costs. Whether you produce or not, you need to incur these costs: telephone costs, security costs, janitor costs. All those things are here, right? Then marketing expenses. Any expenses, advertisements, right? Hoardings, sales items, all those things are coming here, which does not relate directly to this, right? Then finance. Any expense or any payment we made to a bank other than the interest, checkbook charges, commissions, fees, stamp duties, all those things are coming here. So these three items are called overheads, fixed cost. It does not change with the quantity, right? So we denote overheads as D, right? Then we have another profit line called profit before interest and depreciation. We call it PBIT. D, right? Which is E. E equals C minus D, right? That is profit before interest and depreciation, right? Now we have covered all the direct costs, then we have covered all the fixed costs, right? Then after profit before this PBID, then you have interest expense, interest, which is short-term interest and long-term interest both, right? Then you have depreciation, right? That is the allocation we do to replace our fixed assets like buildings, machinery. So every year, part of the profit we allocate to replace our fixed assets. So that is called depreciation, right? So after these two, which is F, you have operating profit, OP, right? Operating profit, which is G. This is equal to E minus F, right? This is operating profit. Then after the operating profit, this is the final profit after business normal operation. Then we have something called other income. Any income we generate apart from our top business. Like as an example, if I am a printer, all the income we generate through printing business comes here. If I generate some income by selling my waste paper, offcuts, then it goes here. Any income which is generated by the business other than the main line of business. I have a spare area. I rent it out. My business is printing. I have rented out part of my business. So then that income is other income, not the top line income. So it is other income. If I am a person who is renting warehouse space, but I generate some income by selling some items, then that income comes here, rent income goes there. So any income which is generated apart from the main line of business is other income. After that we have profit before tax, right? Profit before tax. Right? Profit before tax. I equals G minus H. Then you have tax. Tax profit after tax. J K equals I minus j, right? I minus j. Profit before tax is called PBT. This is called PAT, right? You should know this abbreviation. So when someone tells you about COGS, then it represents cost of goods sold. Contribution, it is the gross profit. PBID, profit before interest and depreciation. PBT, PAT, OP, then OI. So you need to know the abbreviations. You are in the finance business. So basic idea about this should be there. If you are into credit, in the evaluation, your aim is to get this done, get this filled. Whenever you speak to a customer, your aim is to find out details for this. Right? We are not just talking. How much are you selling? Is what? This. What is your purchasing bill? It is this. What is your electricity bill per month? It is here. What is your salary cost? It is here. Right? Like that. Whenever you speak to a customer, it is to find out these items. So this is the P&L, profit and loss statement, or the income statement, or financial performance. Right? You can use any of these words. Financial performance statement is the latest word we use. Statement of financial performance. So this is all about P&L. We need to know this by heart because we are doing the ratio analysis. For that, you need this P&L. Right? Sorry. Yeah. Thank you very much for this. It is not minus, it is plus. Right? It is plus. Profit before tax. Yeah. Operating profit plus other income is profit before tax. Yirma, thank you very much. Right? Okay. Just glance through it again. If you have not written, write it down and ask me any questions if you have. We'll allocate 1 or 2 minutes to clear any doubts on this. Because this is our bread and butter as a credit person. If you want to become a credit person or if you are a credit person. Our aim as a credit people, our aim is to interpret these statements. Not the T accounting, not the accountant's job. But we should be able to look at these statements and predict the business, talk about the business. So each item you should know properly what it does, what does that mean. Okay. So look at this properly and think whether you understood. And if you have any questions, please ask me. It is 11:04. I'll wait till 11:06 to answer you any questions if you have. There is an announcement from the institute. You need to register for the exams by 15th August 2021 before, right? Before this date. If you have not registered, it is on October. So you need to register. before this date if you have not registered up to now. Right? Since no questions, no one, I know I can't hear you anyone, but no one texts me as well. So I assume everything is clear and you know everything on P&L and balance sheet. So I'm proceeding. Right? Okay. Since you are not asking me any questions, I am proceeding. This is the P&L. Then we will go to balance sheet. I need to write this again later, but I am going to erase this. Hope you have written it properly. Balance sheet can be written, balance sheet or the, again, P&L or the profitability is done for a period. It can be for a month, it can be for a quarter, it can be for biannual, or it can be for a year. Normally, it is for a year. We do a P&L for a year. If it is for a quarter or biannual, then we call interim accounts. Then if it is not, is the final account. But so whenever we talk about P&L, we write P&L for financial year 2021. That means financial year ended 31/3/2021. From 1st April 2020, starting from 1st April to this period. This is the meaning of financial year 2021. Right? Normally it's for a year. So it is for a period. P&L is for a period. Whereas balance sheet is balance sheet. Balance sheet, it is as at 31st 3 whatever. You can keep it like this. So it is 2021. Right? Balance sheet is for a day. It is a snapshot. Right? How the money of the business has been invested. Right? So this is for a day. Balance sheet is for a day. Then we go. You have, firstly, you have fixed assets. We call it gross fixed assets. That means all assets are at cost. Land, building, machinery, equipment, right? And building, machinery, equipment, vehicles, work in progress, capital assets. All right. These are land, I don't need to give example. Building, you don't need to give. Machinery. These are the big machinery. If it is a lathe workshop, your lathe machine. If it is a garment, your garment sewing machine, UK machine. Your computers, testing equipment, telephones, all those things comes here, right? Vehicles, work in progress. It is, if you are constructing a machine or a building, when it is part built or part constructed, that is here. Once you fully completed, it goes here or here, right? So work in progress, finished goods. We have different work in progress. That's why I told this. Work in progress, capital assets. So then we have accumulated depreciation, right? So every year we allocate a depreciation provision in our P&L. Year on year we accumulate that. That is called accumulated depreciation. Why? This is a cost. We reduce the accumulated depreciation, then we get net fixed assets. This is net fixed assets, right? You have fixed assets A, then accumulated depreciation B, net fixed assets, which is C, equals A minus B, right? This is the fixed asset. Any asset which has a useful life more than 12 months is fixed assets. Any asset which has a useful life more than 12 months, right? That is called fixed assets. Accumulated depreciation, net fixed assets, right? Then we have current assets. Any asset which can be converted to cash within 12 months period is called current asset. Any asset which can be converted to cash within 12 months is current assets. The most difficult to convert to cash is stocks or inventory, right? Normally it is the trading inventory. Sometimes, this is rare case, so I'm not putting it to the balance sheet. Sometimes you can have investment here. Like I have invested some money in stock market, business money in stock market. It comes here in between fixed assets and the current assets, right? In SME and small businesses, this is very rare, so I am not putting it. But if you see a balance sheet with investment in between this, don't get upset over it, right? Investment comes in between fixed assets and current assets. Stocks or inventory, normally it has to be the trading stock or trading inventory, right? If you are a manufacturer of shirts, material, buttons, labels, packing material, all those things. If you have taken spare parts for your machinery and spare parts for your vehicle, that will be reflecting here. but you have to keep it separately, right? Inventory. Then we have debtors. Can you remember? On the P&L, our sales divided into credit sales and cash sales. Whenever you do a credit sales, there your debtor increases. That is your credit sales is reflected here. How much you need to collect from the market. Whenever you sell, you go and mark as sold, but it increases here. Right? You have not received money, you have just increases the debtors. So any other advance payments? Right? Any advance payment, money given to the director, whatever the amount you can collect from the business, collect towards the business comes here. You have to think like this. If I stop my business today, what can I collect? What is my collection? I can sell my inventory and collect money. I have given on credit, so I can collect that money. I have given money out to directors or employees, I can collect that money. I have made some advance payment for suppliers, I can get those money collected. So all these, whatever the money you have invested and which can be reconverted to cash within 12 months comes here, right? Debtors. Then lastly, we have cash, right? We have cash. So all these together, current assets, we call D. We call D. And any asset which can be converted to cash within 12 months period is current assets. Then we have current liability. Any liability which needs to be settled within 12 months period is called current liabilities. Any liability which needs to be settled within 12 months period, right? Firstly, it is creditors. Normally, it is the trading creditors. If you purchase something on credit, that is the first thing you need to settle, right? Then, if you have not paid your salaries, if you have not paid your electricity bill, all those things comes next. Any payment you need to make within 12 months period is called current liabilities, right? Note payments. Right. Then if you have taken some money from the directors of the company, you have to give that amount due to directors, amount due from directors here. Right. Then you go and you have short-term loans and PODs here. This is your current liabilities. Then we have net current assets or current liabilities, right? If I call this as EDE, this is F equals to D minus E, right? This is current, net current assets. Then I have total assets, which is G equals C plus F, right? This is C plus F. That is net fixed assets plus net current assets or current liabilities equals the total assets, right? Then this is the asset side of it. Finance by share capital. We use the word share capital when it is a company. If it is sole proprietorship, owners capital. If it is a partnership, partners capital. Whatever invested by the sponsors of the business. Then we have reserves, that is the profit we generated from P&L, it comes here, accumulated reserves, right? So join to this, if it is a company, we call net worth, right? If it is plus these two together, we call net worth. If it is a sole proprietorship, you can call it owners funds, partners funds, like that, not net worth. Share capital and net worth, two words are used only when it is a limited liability company or a list or liability company. Then after that you have term loans and leases. Any facility which needs to be repaid over a period more than 12 months. Any bank facility which needs to be settled over a longer period of time comes here, long-term facilities. Then I have net worth H. Then I have term loans I. And then total capital employed. Total capital employed equal I. Sorry, this I. So this is J. J equals H plus I. Right? This G should equals to J always. Then only balance sheet is balanced. Right? This is for a day. You list all the assets which has a useful life more than 12 months here, fixed assets. Normally you used it, you report it on cost. So at cost, so it is gross fixed assets. You reduce your accumulated depreciation, net fixed assets will come. Then you have all assets which can be converted to cash within 12 months period, which is called current assets. Then you have current liabilities, any liability which needs to be settled within 12 months period, right? Current assets minus current liabilities is called net current assets. Then you have total assets, which is fixed asset plus net current assets, right? Then that is the total asset. Then financed by, you have the owners or the partners or the shareholders fund. Then you have reserves, which is called net worth. Then you have long-term loans and leases. Net worth plus long-term leases and loans is called total capital employed. Total capital employed should be equal to total assets, right? Then this part, this part is called equity capital. This is called debt capital. Equity capital and debt capital, how the funds has been invested, right? This is one way of writing the balance sheet. Other way is fixed assets less plus fixed assets less depreciation, net fixed assets, current assets, total assets, right? Then you have current liabilities, net worth, term loans, total capital, right? All liabilities into one side, only the assets into one side. So you can use this format or this format, no harm. Why I have using this format in the class, it is easy for me to explain the another term called working capital when I have this together, right? But this is also very commonly used format. You have fixed assets, you have current assets. Jointly, we have the total assets. Then you have current liabilities, net worth, and term loans or leases. This is the total assets. That means from here onward, it is, if I write finance by here, that format comes in. We take out this part, right? So it is the same. So just go through it. We'll take another 2 minutes, 11:30, 11:32, 33. We will start again. If you have any questions, please ask me. Right? This is the snapshot of the business. Right? It is for a day. No questions means you are very familiar with the P&L and balance sheet, right? Okay, no questions. I'm not going to waste time. I don't know whether you are there on the other side also, because you are very silent. Right? This is the balance sheet, and you need to know everything. So as a credit person, your second name is to fill this. This is to think how the money investment has happened in the business. Where is the money, right? So your day-to-day operation, working capital, everything depends on this. You can have lot of fixed assets, but if you don't have money here, you have problems, right? This indicates the management thinking. This indicates how risk-taking the managers are, how fluent they are, what is their control levels. All those things indicate by this, right? It is not just a P&L and balance sheet. By this, we can predict the management. We can see how efficient the management is in doing their operations, right? Whether they are risk takers or they are very conservative people, or do they identify the opportunities in the market. All those things we can discuss with by just looking at the P&L and the balance sheet if we have a proper P&L and balance sheet. The biggest problem as bankers we face is normally in the business, our SME sector, they don't provide proper P&L and balance sheet. So as a credit person, your aim, all your interview, your discussion with the customer is aimed towards getting the P&L and balance sheet, performance and the position of the company properly. Otherwise, we lend without knowing the business properly will lead to a difficult position for us. Right? Clear? At least tell me clear or not. Then I know that you are there. Thank you, two of you. So this is the we have three statements: balance sheet and P&L we discussed. Then you have the cash flow, which is how the cash came into the business, how the cash has gone out of the business. Operations, we start with the PBID, then financing and investing activities. So financial statement analysis is we tear apart these statements and try to create a logical idea about it, right? Who needs this? Internal people and external people both. Why internal people? For planning, projecting, controls, all those things. We look at the P&L, we compare to, well, now we see sales are coming down. Then the management need to think how to increase the sales. For that, you need financial statement. Management sees the costs are increasing. Then in order to look at that, you need the financial statement. So planning purposes, control purposes, you need financial statement for internal users. External users, who are the external users? The banks, investors, creditors, all those things. the people who are looking at a company, why do they need? They need to understand the operations of the company, how efficient the management of the company, all those things. Finance, like if I am a creditor, I am worried whether I will get my money, right? So in order to know that, we need financial statement. If a banker, I need two things. If I give short term, the company should be able to pay our interest. If I am a long-term lender, they need to pay the interest and capital both together, right? Right. Before going further, look at this. You have short-term current liabilities. Always, current liabilities are settled by liquidating current assets. Current liabilities are settled by liquidating current assets. That means you convert inventory to sales, you get creditors, you collect creditors, and you get cash. When you have cash, you pay creditors, you settle short-term loans. When you settle short-term loans or creditors, you can retake the money from as creditors or short-term, take stocks, sell, create debtors, collect cash. So it rolls. Once a short-term facility is given, it is a bucket of water. You can fill it, you can take it out, fill it, take it out, you can use, right? What is a POD? It is a limit marked over and above the credit balance of a current account, so the customer can freely write checks within the limit. They can settle, they can retake, right? Always, this is settled by liquidating them. Only the interest portion is serviced by the profitability. Whereas a long-term loan, once paid, you can't take it back. So it has to be settled purely through your profitability. Long-term facilities are paid through profitability, whereas short-term facilities are serviced by profitability, but capital of short-term will be settled by liquidating current assets, right? So remember that carefully. Regulatory agencies, all those things. What do internal users? Planning, evaluating, controlling. What does external users? Past performance, current and future prediction. Profitability, solvency, this is ability to pay, and effectiveness of the management. Information on a annual report, financial statements, notes, letter to stockholders, auditor report, management discussion, and then we have risk discussion and the environmental discussion, right? All those things are here. All other information you can get it from periodics, papers, and those stuff. These are Moody Standard and Poor rating agencies, right? They also comment on companies. You can take a report on them. Then we will discuss this horizontal methods of financial statement analysis, right? P&L, turnover, direct cost, gross profit, overheads, profit before interest and depreciation, interest, depreciation, operating profit, other income, net profit. Right? Then you have balance sheet. I start with net fixed assets, current assets, current liabilities, net current assets, so current liabilities, total assets, finance by net worth, and term loans and leases, total capital employed. So these are the two statements we use. Then we talk about horizontal analysis, right? What we do on under horizontal analysis is we take P&L, we say it can be P&L, low balance sheet, whatever. We have 2019, 2020 and 2020 and 2021. 2 years. We are comparing 2 years horizontally, right? On a single balance sheet to P&L item. What was the turnover? Turnover, this is 10 million rupees, right? This is 12 million rupees. What is the difference? 2 million or 20%. So we are comparing single P&L item or balance sheet item between two timelines. It can be amount, it can be percentage. 2 million divided by 10 million, that is 20%. Right? Horizontal analysis means we are comparing two financial periods or financial dates, one single item. Horizontally, we are comparing. It can be rupee value or it can be percentage value. Then we go to vertical. Vertical means we represent all these items as a percentage to a major item. Right? And we compare what is the percentage of gross profit. Turnover divided by turnover. Gross profit, GP divided by turnover. GP divided by turnover. PBID divided by turnover. Right? So it is a comparison on a single financial year period, how each item represents a major item. This is a vertical analysis. Right? It can be vertical here. We are not comparing two periods, it is single period. Right? Then we have third one, which is trend percentage analysis. That is, we take turnover and we take several years, Y1, Y2, Y3, Y4, Y5, like that, several larger number of years, and we compare how the turnover has changed. And whether it has changed like this, whether it has changed like this, or it has fluctuated. Right? That is trend percentage. How the trend, what is the trend in the turnover? We are analyzing a single P&L item or balance sheet item for a longer period of time. It is horizontal analysis is only two periods. But trend percentage, we analyze for longer period of time. Vertical analysis, it is vertically. It is for a single period. Right? These are for two periods, one single item. This is one single item, large number of periods. Then we have percentage financial statement, common size financial statement. What is a common size financial statement? All the items in the financial statement has been presented as percentages, not in rupee values. It is percentages. Why are we using that kind of financial statement? Is to avoid the size difference of a company. See, if I want to compare two manufacturers in soap manufacturer, one is in the range of 100 million and the other is into billion. Like I want to compare Unilever soap manufacturing plant and a small soap manufacturing plant. Which one is more efficient? You can't compare because it is a billion business, this is a million business. Right? So what we do in that kind of a scenario, we take the P&Ls and balance sheet as percentages. I will just show you one. Right? Unilever, all operations are represented as a percentage. Everything percentage of turnover. Everything percentage of fixed assets. Like that. Right? So we work on percentages, not absolute terms or numerical terms or rupee values. So that is called common size financial statements. Right? These are the four types we have: horizontal analysis, vertical analysis, trend percentage analysis, and common size P&Ls and balance sheets. Right? See this one. See this statement. Right? Everything is represented as a percentage. Okay. Total asset is 100%. All other items are given in percentages. Right? This is the normal one. This is the common size one. Right? So everything is percentages. This is the turnover. This is the common size income statement. This is the normal one. Okay. Vertical, horizontal, common. Ratio analysis is analyzing the logical relationship between these items. Right? We will be going in detail on that. So we are doing this. Through this, we will be using these methods. Horizontal, using comparative financial statements to calculate rupee or percentage change in a financial statement item from one period to the next. That means 2 periods we are analyzing. Vertical, for single financial statement, each item is expressed as a percentage of single total. Example, all income statement items are stated as a percentage of revenue. Common size statement, financial statement that shows only percentage, not absolute rupee values that I showed you. Trend percentage show changes over time in given financial statements, can help evaluate financial information on several years. This has come down. Now we are at the ratio level. Ratios can be expressed in 3 different ways. It can be shown as a ratio, which is 1:2, 2:1, like that. Current ratio is given the first line. Yeah, I'm presenting, right? Right. So this is one way of presenting ratios. Then the second way of presenting is a percentage. Then even rupee terms, we can show a percent ratio. Earnings per share, EPS, is 2.25. It's a ratio, right? You have to be very careful. When you are using ratios, you have to know the underlying cause. Otherwise, you will come into incorrect conclusions, the reasons behind ratios. So that's why I started with saying, you are not accountants. You want to interpret the accounts to identify the operations, management activities. So there you need to interpret. So always you need to know what is behind this. Just a figure does not mean anything. But how you interpret that means lot. So using ratios and percentages without considering the underlying causes may hazardous to your not health, lead to incorrect conclusions. Right? Like I give you example. Year on year turnover has dropped. Right? It is a bad sign. Okay. But if you interpret properly why the turnover has dropped, company has get rid of low margin products. So they have stopped selling some products. So their products mix change, right? Whereas even though the turnover dropped, their profitability has grown. Right? Without knowing this background story, if you just say turnover has dropped, immediately we'll jump to the conclusion company is facing difficulties, right? Market issues. So in order to avoid that, you need to know the story behind any ratio. There are 4 types: liquidity ratio, equity ratio, or long-term solvency. Like we call it liquidity, we call solvency ratios, we have profitability. Liquidity ratio is to deal with current assets and current liability. How liquid your company is. This is to deal with short-term debt paying ability. So when we are talking about liquidity, how liquid? Do you have cash? You may be having fixed assets, machinery, building, but if you don't have cash to run the business, you have a problem. So in order to look at that, you look at liquidity ratios. Then we have solvency, long-term ratios. It indicates, it deals with the relationship between equity capital and debt capital. Ability to finance equity capital and the debt capital. Solvency, financial risk, how risky the business is. Because larger the debt capital, riskier the business is. Why? Whatever you earn, major portion should go to service the debt. If your earnings drop, your debt servicing ability will drop. Then profitability test, income related test, how profitable the business is. Then you have efficiency ratios, which I will talk about, how efficiently you are managing the business. Then you have market test. Market test is only for listed companies. That is to talk about the merits of the stocks or shares in the marketplace. So you have liquidity ratios, you have solvency ratios, you have profitability test, you have the market test, and you have efficiency ratios, right? These are the several ratios we have. We have 10 ratios to discuss. You have liquidity ratios, current working capital or current ratio, asset test, account receivable turnover, number of days. We will use different words. Inventory turnover, then equity, stockholders equity ratio. Profitability, you have net income to net sales, return on equity, earnings per share. Market test, price earning ratio. Like that, we have 10, we will be discussing 10 ratios. Okay. So similarly, we can use this statement. Those are the figures. So I will do this today. Working capital, right? Sir, what is the most efficient method to do financial analysis by banks from these methods? See, Jitma, we are basically using the ratio analysis, right? For the banks, we use mainly the ratio analysis. Vertical, horizontal is methods we use while doing the ratio analysis. Like if you are comparing two periods, then it is a horizontal analysis. If you are talking only about a single period, it is a vertical analysis, right? So basically our aim is to use the ratio analysis. Did I answer your question? Okay, all right. Let's go back to the board. You can see. So here, initial one is working capital. Current assets minus current liabilities. This one. I told you I wrote this together due to this. Right? If we have current assets of 25 million, we say current assets is 25 million rupees. Current liability is 15 million. So 20 million and 15 million. Right? So working capital is 20 million. 20 minus 15, which is 5. Right? What does this represent? The portion of current assets which has been financed by long-term funding. That means you don't need to convert that funds, that assets to service this. Over and above the current liability, the working capital represents current assets which has over and above the current liabilities. That means that part is financed by long-term loans, right? Though it is not a ratio, we use this working capital. It shows the liquidity of the business. Even after settling our current assets, current liabilities, we have adequate funding. That is the meaning of this. Say if you, then we have current ratio. Right? Current ratio is we have current assets divided by current liabilities as a percentage. Or you can say 2:1, whatever. You have two different things. Current ratio 1.5 times. Right? Like that you can mention, or you can say 1:12. So this ratio can be shown in both these things. Right? Current ratio, current assets divided by current liabilities. What does this indicate? This indicates current liabilities. Liabilities which needs to be settled within 12-month period is covered. What is the coverage we have from current assets? Right? Current assets are assets which can be converted to current cash within 12 months period. So current ratio indicates what is the coverage we have for current liabilities. Who requires this? Current liability holders. Who are they? Creditors, short-term lenders, all the people in current liabilities need to know this. Why? Because they are worried about their money, right? We say you have inventory, debtors, all other things, cash, right? So you need to convert them to cash to settle current liabilities. We say we have 25,000, right? Your current liability is 10,000. Current assets divided by current liability, it is this to this divided by this 2.5. What does this mean? Each rupee of current liabilities are covered 2.5 times by the current assets, right? So I am very relaxed. Even if only 50% of this can be converted to cash, I can get my money. Even if only a part of the current assets can be converted to cash, current liability holders can get money. What will happen this? $20,000 now. $1.25 times. Now it is coming down. You need to convert large portion of the current assets to pay the current liabilities. Then current liability holders should get worried. What will happen now? 23,000. It is nearing 1. If it is 25 to 24, then almost everything needs to be converted to cash to service the current liability. That is riskier, right? Current assets, current ratio represent the liquidity of the business. What is the coverage current liability holder has by the current assets? So this should be in the range of 1.5 to 2%, right? 1.5 to 2%. If it is more than 2%, that is also not good. Why? They have not utilized the current liabilities, which are creditors. It is free cash. Short-term borrowing. Short-term borrowings are low cost than long-term borrowing. So that indicates the inefficiency of the management. So If a current ratio is in the range of this is reasonable, right? Then we have quick ratio or acid test, which is current assets minus inventory divided by current liabilities. We take out the most difficult current assets to convert to cash, and we check the same thing. After deducting this, what is the coverage we have? If you have a coverage more than 1, it is a good coverage. Quick asset, quick ratio. So normally we take cash, we take debtors, we take marketable securities, all those things. You can write this way, or you can have the marketable securities and all those things separately and add it up, right? So this is the current ratio and quick ratio and the working capital, which covers the liquidity of the business. How liquid? What is the cash availability? Ability to service the current liabilities. Ability to service the current liability. What is the coverage current liability holders have from the current assets? Why? Current liabilities are settled by liquidating current assets. Only the interest portion is serviced from this P&L. Right? So we came a long way today. So I will stop here because I have other issues to start. But before starting that, let us get this confirmed and go into a break. We will do the other ratios next week. So Marisha, question is not clear. Will you discussing the examples given for the methods of financial analysis on later date? Which example are you talking about? The handout? Yeah. Just hold on. Are you talking about the handout, which is? Are you asking this one, this kind of things? Are you asking about these kind of examples, Manisha? Yeah, basically, like these examples are for you to work out. I just gave the brief idea, like say, if it is a horizontal analysis, it is the comparison between these two. Let me go to that. See, horizontal this is a horizontal analysis, right? I took you all of you through this. 520 is the this year. 480 is the base year. So On a horizontal analysis, net sales, it has an increase of 40,000. 520 minus 480, right? 40. 40 divided by 480 is 8.3%. So that is a horizontal analysis, what we will do, right? This is an example, so you can work out and see. I just took few items from that. I didn't go one by one. So it is basically horizontal analysis means one single balance sheet item or P&L item, but two different periods, right? This year and the next year, or last year and this year. Basically, it is last year and this year. So you are comparing the base year with the current year. It can be rupee terms, or it can be percentage terms. That is a horizontal analysis. So all these things are that. I just took few of the lines. Then when it comes to the vertical, it is we represent the single financial period, like this year, March 31st of this year, what is the P&L? All P&L items will represent as a percentage of turnover, right? Or balance sheet as a percentage of total assets. Like that, you represent the balance sheet and the P&L as a percentage of a major item. See this one? This is the total major item. So I'm representing everything as a percentage of that. 82 divided by 483 is 17%. 112,000 account receivable divided by 480 is 25%. Like that, you represent. So that kind of a thing, you can work it out. I just took few lines. All right? Okay. Because horizontal analysis and vertical analysis is inbuilt to our ratio analysis end of the day. Right? What we do, we will work out ratios and we will start comparing that. When we are comparing 2 years, we will have horizontal analysis. When you are evaluating a P&L, we have vertical analysis, like that. Right? That's fine. Right. Okay, then thank you very much for today, and we will meet next week and continue from here. Thank you.
Thank you, sir.
Be here for 1 or 2 minutes. You can ask me questions if you want.